My biggest fear is that we go into a recession that doesn't last a year or two, but lasts 4 or 5 years, and it becomes what we call stagflationary. I am very concerned about the macro. I mean, we've been in this cycle since 2009 where the Federal Reserve has bailed us out every time things have gotten tricky. It's kind of like a parent that doesn't allow their children to ever fail. And so we're getting to this tipping point where we are going to hit a head where it's unsustainable to keep just taking on more and more debt. There will be a point where people will not lend countries that have crazy debt to GDPs any money because they know that they can't pay them back. And that's where everything collapses. So CBDCs, it's one of those things that does concern me. I mean, we're almost in a cashless society. Everything is really tracked. And a CBDC only takes that to the next level. Now, people will say, well, if you're not doing anything illegal, then no big deal. But what's not illegal today could be illegal in 5 years from now or 10 years. You could show me a chart with no name on the company, no nothing, and I'm going to look for what I look for in those charts, and I make money.
Today we interview Gareth Soloway, a professional trader for 25 years, chief market strategist of verifiedinvesting.com, and host of The Game Plan on YouTube. Welcome to the show, Gareth.
Hey, thank you so much for having me. It's an honor.
When I first went onto your Twitter, I saw professional trader, 25-year professional trader, or something like that. I thought, wow, what an accomplished gentleman, 25 years old and already such a successful trader. But obviously turned out you've been doing this for 25 years, so it's good to have you on.
That's right, and I've made my fair share of early mistakes and learned the lessons the hard way. So I'm seasoned in that way.
As we all do, yeah. So let's get into the micro first. We had the important Fed meeting on May the 1st. Overall, the market has reacted positively as Powell's comments were milder and a bit more dovish than expected. At the same time, we had some big moves on earnings lately too. So some notable names are down, including Meta, down 12%, Netflix down 10%, DoorDash 15%, Starbucks 20%. We also had stocks with big swings like Tesla and DJT, Trump's media stock. Lots of things happening. All in all, Gareth, what are you paying attention to these days? Let's start with the micro and then zoom out.
Sure. So going back to the Federal Reserve announcement, I think going into it, there was so much concern and so much kind of, hesitation that the Fed was going to be unbelievably hawkish and maybe talk about rate hikes instead of rate cuts. And then really Jerome Powell kind of came out. He was hawkish, but he wasn't overly hawkish. And in fact, you could even argue that they talked about reducing their balance sheet runoff from $60 billion down to about $25 billion a month. And that's actually a slight way of easing monetary policy. So I think that gave the markets a sigh of relief that, oh my goodness, they're not thinking that inflation's running away from them at this point. And that really kickstarted a drop in the 10-year yield and the stock market rally. And then you throw in earnings from Apple obviously coming in. And again, this is the kicker with Apple. Apple's revenues year over year were down. I mean, their earnings just continue to kind of stagnate and their revenue declines. Their iPhone sales are down, but they announced these monster share buybacks of like $110 billion, which to me is financial engineering, right? So for those of you watching, when you buy back stock, when a company buys back stock, they basically eliminate it from the amount of shares in the company, which means that if they make the same amount of money that they did the previous year, that money is spread over less shares and therefore earnings go up. So what we call it here on Wall Street and in these trading rooms like I have is financial engineering. It's a way for the company to make themselves look better without actually doing better on revenue and earnings.
Yeah, so they announced these 110 billion of stock buybacks. Raised their dividend by 4%, and stock adds 180 billion in market cap after the announcement. So that's quite notable. Can you shed some more light on this? Provide a bit more context on that.
Yeah, absolutely. So number one, investors right now are into this. The share buybacks are amazing because they know it boosts the share price because there's less shares. The dividend really attracts more and more investors. Like Warren Buffett has a huge position in Apple, so it's going to bring in bigger investors because they want the dividend. And then one of the things to look at here, if we look at the chart of Apple, and I'm going to get rid of my trend lines here, But if you look at Apple compared to the other trillion-dollar names like Meta, Google, Amazon, NVIDIA, this stock made its all-time high back in December of 2023 and was actually down pretty significantly going into earnings. And so people's expectations were pretty low compared to a Meta, which went in at all-time highs to its earnings. And we know what happened to Meta. Meta just absolutely got annihilated, dropping 10, 15% on those results. But with Apple, the bar was set really low. So they just had to do okay. And then you throw in this share buyback and the dividend hike, and it really made investors say, holy cow, let's get back into this stock, and it bounced up tremendously. The other thing to mention here is, we've been in an earnings season, and you brought up DoorDash, you brought up Starbucks, and it's important for us to recognize that for me as an analyst, as a technician of the charts, as an economist, I'm looking for little signals about the economic kind of health of the U.S. economy and really the global economy. And when I see Starbucks, which I know people that literally cannot live without going to Starbucks every single day. And so when I see that their sales are starting to suffer, when I see DoorDash dropping sharply because they're seeing less action, that's people getting delivery of food, so they're cutting back on that. Even though the jobs numbers have been relatively good, it is telling me that the consumer is starting to feel stretched. And I think it's important to recognize that, we had a period here in the U.S. specifically, and I think around the world, where people had a lot of savings during COVID. They weren't driving, they weren't going out and spending money, so they saved a lot of money. And what that created was this kind of feeling like, hey, I have a lot of savings, let me start going out to eat more, let me travel more, let me spend more money. It's gotten to a point where the consumer has run up $1.1 trillion in credit card debt, and they've spent all these savings down. And this creates a scenario, unfortunately, where the consumer is now getting so stretched with debt that they're being forced to cut back on buying things like Starbucks, like food delivery through DoorDash, and even Etsy. Etsy had a bad earnings report as well, and that's a consumer-led driven stock. So I do think that we're starting to see some of these bigger kind of cracks emerge, even though, again, we're still creating jobs. We have the jobs report today, and it was still a pretty solid jobs report, but it was weaker than expected, and I do expect us to be in a recession by later this year.
Yeah, so Starbucks was down after a bad quarter, first 10, then another 5% after let's call it terrible TV appearance of the CEO. Went down 5% in real time. But that quite nicely leads us to the macro. So I guess your overall view of the macro right now is not very positive.
Yeah, I am very concerned about the macro. We've been in this cycle since 2009, where the Federal Reserve has bailed us out every time things have gotten tricky. It's kind of like a parent that doesn't allow their children to ever fail. They're always there to catch them if they fall. It's not healthy. It makes the child reliant on the parent. It makes the U.S. economy and the investor reliant on the Federal Reserve. And that's all fine as long as inflation stays around 2%. The problem is we're now getting into a cycle where inflation is staying 3 to 3.5%, maybe 4%. And that makes it very hard for the Federal Reserve to cut rates like they might want to if the economy gets into trouble. And to be fair, if you look at the jobs numbers and you really delve into the details, the headline numbers look okay. But what we've seen is that even though jobs are being created, a majority of the hiring is government. We've seen full-time workers actually lose jobs over the last few months, while part-time jobs have increased substantially. And when that happens, by the way, that's telling us that essentially people are having trouble finding full-time, so they're accepting 1 or 2 part-time jobs. And this can be seen in the U6 unemployment report, which came out today at 7.4%, and this has been consistently going up. So again, U6 are people that are underemployed. They want a full-time job, but they have to accept a part-time job, and that number continues to go up. And these are all signals that if you look at previous recessions, they've all been precursors to a recession. So again, the question is, how bad is the recession going to be? And honestly, I don't know that, but I do know that we are seeing the signs of a recession that probably hits later this year.
Do you see this switch from part-time to full-time and these other signals continuing? And what do you think would be the catalysts that, if you put on our negative hat here, right? What are the catalysts that would bring us somewhere where we don't want to be?
Yeah, so I think the biggest thing is going to be if inflation doesn't come back under 3%, when the economy does slow enough to where the Fed needs to cut rates aggressively, what happens if they can't. And when I say they can't, I mean they could, but the problem is what we know is that when they cut rates, it makes money free or closer to or cheaper. And so people borrow money and then they put it into the economy, and that creates inflation. And so we had this period in the 70s where we had this initial pop on inflation. It came back in, and the Fed then loosened rates too quickly, and we had a secondary move up that went even higher on inflation. And then again, we saw it come back down, and the Fed again was too quick to cut its rates, and we saw inflation soar even higher to the point where we were seeing inflation well over 10%. I mean, back then interest rates were at 15 to 18%, which is unheard of in this day and age. But that was because they had to combat inflation. And so I think the biggest issue here is if we can't get inflation back into the box, essentially, then the Fed cannot stimulate during the next recession. And my biggest fear is that we go into a recession that doesn't last a year or two, but lasts 4 or 5 years. And it becomes what we call stagflationary, and also just this drawn out recession that can really hurt people.
A couple of things. How likely do you really think a stagflation is? And maybe let's also explain the term stagflation once more, because I think not everyone is aware of it. So how likely do you really think that is? And then also, how bad can it get? I think it's always difficult to quantify that, but maybe we can try to do that.
Yeah, so to define stagflation is where you have inflation but a slowing economy or a recessionary economy. And you might say, well, doesn't that happen all the time? And the answer is no, not really, because usually when there's inflation, the economy is growing and people have more jobs, they have more money, and the demand from the goods, that because people have more money, pushes the prices of goods up, and that creates inflation. So in general, when you have inflation, you have a good economy. The worst scenario is where you get a stagflationary economy, where inflation is still high or rising, but the economy is going down. And the reason why that's so bad is because people are losing jobs or making less money, but prices are going up, versus the normal scenario where prices are going up, but because people are in a good economy, they're making more money and can afford to still pay up for those items. So the stagflation is really kind of the boogeyman, if you will, of the economic scenario. And again, that's the one that we don't want to see. Now, again, to quantify how bad things could get, my guess is in the next few years, not that bad. My more concern is that the Fed will ultimately have to come out and stimulate and cut interest rates to offset recessions. And my worry is later this decade, if that continues, there's going to be a breaking point where the U.S. debt now at near 35 trillion, the debts from consumers are getting overbearing. Debt to GDP in the U.S. is 130%. We see debt to GDP in Japan 250%. And look at what the yen's done lately. The yen has begun to collapse. And so we're getting to this tipping point over the next 4 to 5 years, in my opinion, where we are going to hit a head where it's unsustainable to keep just taking on more and more debt. There will be a point where people will not lend countries that have crazy debt to GDPs any money because they know that they can't pay them back. And that's where everything collapses. So to summarize, I think in the near term, it's going to be a few recessions, right? I mean, you're going to get a recession. It may be not so fun, but it's not horrendous. But it's more over the next 5 years that I worry later on this decade, we could be in for a major reset that could take us into something like a depression.
On that note, how are you looking at elections this year in regards to the impact on markets? I mean, obviously, historically, stock market performance around election year wasn't too bad, right? But I'm also interested, we have this whole debt issue that some people talk about, some people don't seem to care about it at all. You seem to care about it.
I do.
What do you think about this?
Yeah, so I'm a big believer that you have to treat so it starts at the top, right? And you have to, as a government, treat the system as a business. And businesses give charitably too. So I'm by no means saying cut back on a lot of social measures that help people. I think you have to do that. But you also have to mind your debt levels, and you have to be able to pay your debts. Just like me, I'm running my household. I may have some debts, but I make sure to make payments, and I make sure that doesn't get out of control. And so you have to do that across the board. That's how you keep a healthy household, and the same thing with a healthy economy and a healthy government spending kind of program. So I take it as a big deal, but our politicians do not, because in the U.S. here, you have elections every 4 years, right? So the tendency is for politicians to only care about the economy for the next 4 years so that they can get reelected for the next 4 years. And it creates a system where it's instant gratification. All they care about is, can I do this right now? Even if it's not good long term, who cares? I'll be retired then. It'll be someone else's problem. And it's a horrendous way to go about it because it's so bad for the country. But that's the way the politicians think, right? And so, I'm one of those people that I don't think politicians are that much different. They they have different policies, but for the most part, when someone's in the White House, they're going to do what's best for them at that particular time to make people like them, and they're not going to make the hard decisions. And for the U.S. to get that debt under control, we are going to have to take on austerity measures. You're going to have to raise taxes. You're going to have to cut spending, and that's going to push us into an even tougher economic point, which basically will guarantee that whatever president does that is not going to get reelected, right? They're not going to be popular. But in the long term, do I think in 20, 50 years, whoever does that will be looked back at and said, wow, that was like the best president ever? Yes, I do. But currently, that's not going to get them reelected. So most of them, even if they talk a tough game going into the election about cutting spending, I highly doubt that any of them actually will. And that's unfortunate.
So what's the worst case of the deficit continuing under the Biden administration versus what would happen if Republicans aggressively shift course?
Yeah, I mean, so these are tough questions for sure. So I think in general, the Biden administration is taking it very lackluster in terms of, listen, we've got to forgive debt for university students. We've got to do this. We've got to spend. We want to stimulate the economy. We want to bring the lower income people up to the middle class, which is admirable. I'm all for that. But I think, again, it's past the point of no return, meaning that we can't just do that and spend more money. And if we do that, which is fine, we then have to cut back from other areas. And the question is, where do we cut back from? Do we cut back from military spending? Do we cut back from Social Security, which then hurts people there? But ultimately, there's no doubt that the debt will continue to rise. And now if you have a Trump administration, I do think there will be cuts to certain programs, but then it tends to be cuts to programs that are maybe a little bit more hurtful to the poor versus the wealthy. He's talked about kind of maintaining the lower tax rates for the wealthy. And so ultimately, I don't believe that either candidate will seriously bring down the U.S. debt. I think it's going to continue to rise, and it's going to continue to rise until other countries finally say no more. And at some point that will happen. I just don't know at what debt level that will happen.
Let's talk about the Japanese yen situation. You already touched upon it earlier. It's clear Japan is intervening to support the yen. Twice this week, we saw the yen fall to its weakest point against the US dollar since 1990. And this was the first time in 34 years that one US dollar converted to 160 yen. Immediately after, the yen neared 160 twice this week. We saw a steep drop in the conversion rate, strengthening the yen. So how closely are you monitoring what is happening in Japan? Maybe describe for the audience what's going on. And
yes.
Further, what implications could this bring for global markets?
Yeah, so this is a scary situation because essentially the yen is collapsing. And you're right, there was obvious intervention. And if you look at the chart here, you can see we had this beautiful kind of wedge pattern and then this technical breakout. And then, like you said, at 160 to the penny, basically, all of a sudden it collapsed back down. And what's interesting is on the chart, it's actually come back to what I call the scene of the crime, which is this high connected to this high right through here. Look at how it broke out, and then it came right back to that 151, 152 level. Now, this is technical support. I'm a technician of the charts. I would say, okay, this is the big battle of the yen. It's usually going to bounce here and go back higher, the dollar yen meaning it would weaken. But we'll see. We'll see if there's more intervention. But one of the scary things about it is that Japan owns more U.S. debt than anyone else in the world. And one of the ways that they can prop up their currency is by dumping U.S. debt on the open market. And one of the implications of that is that when a country dumps more supply on the market and there's more supply to be had, interest rates have to go up to make people interested in buying that debt. There's more supply, so you have to essentially entice people to take on that debt by raising the amount of interest that they're going to get. And so this is one of those scenarios where if the yen keeps weakening, Japan may have to start unloading more and more U.S. debt, which again then works against the Federal Reserve potentially in trying to get inflation in the bag, get interest rates to start coming down. And again, this can take the control away from the Federal Reserve, where they either have to buy all this debt up and they're trying to reduce their balance sheet, or they have to let interest rates go higher. So this is a tricky scenario, but this is just one. I mean, you look at China, the amount of debt they have. I mean, there's so many countries out there where debt to GDP is really at astronomical levels. And it's really the only reason the US dollar is holding up is because if we look at the Dixie here, the DXY, and we'll bring up that now, the Dixie is falling the last few days, but it's actually had a big rally to the upside. And I still remember months ago, so many people were, the dollar's done, it's de-dollarization, crypto's taking over, and then all the dollar's done is basically go higher since then. And it's not that the dollar is getting more buying power. It's not like you can buy more with the dollar here in the US. In fact, you can buy less. It's that the dollar is versus all the other currencies out there. And the dollar is still the prettiest pig on the lot, if you will, or the prettiest house on the block. Even though it's not a pretty house to us, it's still the best one out there. And therefore, the money flow still goes into the US dollar. But you can see what's happened to Bitcoin, gold. I mean, commodities as a whole, we've had a big commodity run. And that's because, again, people understand all these currencies are getting printed into oblivion, and eventually hard currencies, hard assets are the way to go.
On the bright side, let's talk about big tech for a second. We had these buyback announcements that we shortly talked about already. Google or Alphabet and Meta earlier this year. So Alphabet authorized its first ever dividend of 20 cents per share, as well as a new 70 billion share repurchase. The news announced alongside first quarter earnings helped to send the Google parent shares up 15%. And for Meta, they'll pay a 50-cent dividend, its first ever. And they have authorized a 50 billion share buyback. How do traders look at these buybacks? And to what degree will these buybacks help the current tech and AI narrative-driven rally to continue?
Yeah, so I do think the buybacks, I mean, in general, investors like them because it artificially, again, inflates their earnings per share, which then helps their stock price go up. So I think overall investors like them. But again, my bigger issue with that is that it essentially is, like I called it earlier, financial engineering, where these CEOs, these CEOs are compensated based on stock price. And so when they can buy back $110 billion like Apple announced, their stock price is going to go up. It's just there's less shares out there. So even if they're not making more money, their stock price will go up ultimately. And then what happens, the CEOs get a $20 million bonus or whatever it may be. And so you have to wonder, and again, this is something that the government and the regulators have to figure out is this the right way to do it? Again, you're not getting really tax revenue from that either as a government versus if you paid that out in a dividend, you would get that as tax revenue as a percentage. So there's positives and negatives to it. But again, for me, I don't like it because, again, it kind of skews it. Like, Apple, instead of buying its own stock back, could go buy another company and continue to innovate, right? I mean, they could buy an AI company. They could buy something else. And instead, they're just putting it back into the stock, which makes it go higher, which makes shareholders happy. But again, it generally impacts the top players, the Warren Buffetts that own billions and billions of dollars of Apple versus the smaller investors or the smaller bracket of earners.
I want to throw in a audience question here by Celebrity Schwartz, and he or she, what if I trade only blue chip stocks and don't sell if they go down because they are too big to fail and will go up sooner or later? Now, that seems a bit naive at first, but I think it's actually an interesting question if we take a bit of a philosophical angle on it.
Yeah, so I do think so blue chips specifically, blue chips do offer a little bit more safety because, they've been around for a long period of time. They make money, they pay dividends. versus if you're playing small caps or mid caps, those companies, some of them won't survive. I mean, especially with interest rates now and borrowing costs as high as they are, they just won't survive. So I think that's kind of the safer way to build long-term wealth. Is they aren't the sexiest companies like you invest in IBM or you invest in AT&T, and you're not going to make a fortune on it, but it's the consistency of dividends and slow and steady grinds higher that really make people that have small amounts of money invested, by the time they retire, have a lot of money invested. And I really think, to be honest, going back to my early years, I traded lots of risky stuff and I got hammered, frankly. And now I'm much more in that cusp of saying, okay, is this a good company that I'm okay owning for the long run? Even if I'm trading it in the short term, at least I know it's a solid company that's not going out of business.
So May just started, and once again, investors are confronted with the old saying, sell in May and go away, but remember to come back in September. What's your take on that? It's an old adage. Is it still relevant in today's market conditions? How much weight do you even give this?
So I don't give it a ton of weight anymore. I think we are in much more of a global market with so many, billions of participants now. It used to be very much like the summer hit, the dad that worked on Wall Street and invested, he's home with the kids now, they're going on vacation, they're going away. Generally, you do get a little quieter volume during the summer months, but it's not like it used to be. And again, I've seen some wild periods and wild swings, especially these days with, every Fed announcement over the summer is going to be a key thing. Every economic report that has to do with inflation is going to be market moving. So again, it still holds a little truth, but not the truth that it used to, for sure.
Now let's switch gears and talk about Bitcoin and also maybe gold a little bit. We had the halving recently, obviously, the ETFs, and now the worst monthly performance since November 2022. Despite that, Bitcoin is still up more than 35% year to date. What's your outlook on Bitcoin?
Yeah, so my outlook remains a little bit skeptical in terms of whether or not there's more downside. I'm still in that camp that I still think there is more downside. We've had, like you said, a pretty rough month for Bitcoin since last November or so. But I think the key here is, at least today with Apple rallying and the stock market rallying, we are seeing some good upside in the stock. So again, nice move up today. You can see this little channel that's developed. We did puncture it down here on the chart, but again, we've recaptured it. But one of the things that I'm noticing is that when the stock market sells off because of fear, Bitcoin is starting to sell. In fact, if you look at the S&P high, in fact, let's go to that chart right now. The S&P high, basically, it was in mid-March. If we look at Bitcoin, the Bitcoin high was also right in mid-March. And so there is a correlation with the stock market. And so for me, when I'm analyzing the stock market itself and I'm saying, okay, guys, yeah, we're bouncing, but I think there's more downside, it often leads me to think that, okay, Bitcoin will also have a little bit more downside as well. So I would say, if you're a long-term investor, I'm a huge bull on Bitcoin. I think it's going to 100K within a couple years. But in the shorter term, if the stock market goes lower, just be aware that Bitcoin could go lower with that.
Interesting. Okay. So Bitcoin or gold, which one's going to be the best performing asset this year?
So I personally think gold is going to be. And again, gold's had an amazing run. This is one that I said would be the best performer this year, starting this year, at the beginning of this year. We pulled back a little bit on the chart here, but Bitcoin's the pure play. Gold is the pure play, meaning that it's the safety asset, it's the inflation hedge, it's basically everything that investors want right now. Bitcoin is eventually going to get into that digital gold kind of atmosphere. It's just not at that maturity level yet. There's still too much worry. There's too much volatility in the asset. But again, gold is the pure play. So I'm a believer that we'll be over 2,500 by year end on gold, and very possibly by 2025, at the end of that year, 3,000 would not be shocking on gold.
Okay. I want to throw in another audience question here by Luke FX. What's Gareth's opinion on CBDCs?
Yeah, so CBDCs, so it's one of those things that does concern me, right? We're almost in a cashless society. At least here in the US, I almost never use cash anymore, which means that basically everything is charged on a credit card and it's tracked. And a CBDC only takes that to the next level, right? Where at that point, everything is really tracked. And so you have to be aware of that. Now, again, people will say, well, if you're not doing anything illegal, then no big deal. But my issue with that is that what's not illegal today could be illegal in 5 years from now or 10 years. I mean, things change, governments crack down, there's different governments that take hold. And so it does concern me. There's no doubt about it. I would prefer if we don't have something like that. The only other thing I would say is that the Bitcoin maxis, they say, oh, well, Bitcoin's great. But to be honest, everything's tracked on the blockchain anyways. And so it's kind of unfortunately going in that direction. And there's been speculation that, maybe Bitcoin secretly was a government project. Maybe Nakamoto was a government player and they created this to really backdoor a CBDC into the system. We don't really know. I still like Bitcoin, but I think people just have to realize that we're getting into a society that everything is tracked no matter what. You can still have physical gold. I still have some physical gold. I still have some cash, and that's always the best way to go, but it's just not the norm anymore.
Cool. I want to transition now and bring up a couple of audience questions. This is a little bit like a trading crash course, and we received lots of questions from aspiring traders in the audience. I guess aspiring traders. Most of them probably don't trade actively. And let's start with the wealth channel. I have some questions. Can we view trading as career option and make consistent earnings for like our day-to-day bread? And how much, at least starting capital, should we have to start that as a beginner?
Yeah, so the first thing to recognize is that for me, and I can just speak from my personal experience and from traders around me, is that if you try to be a trader, it is a long process of learning how to do it. It's incredible mental discipline, psychology, and the ability to read charts. And so when I started, I lost money for years trying to do it until I finally corrected many of my mistakes. And I still make mistakes today and still lose money today, although I'm a net positive investor, meaning I trade and I make money over the course of a week or a month and a year. But it's not easy. To be honest, you want to be in a position where if you're ever going to try to be a trader, you want to use money that you are not reliant on for your everyday bills. You need to have that all taken care of. Some people say, hey, can I just quit my job and be a trader? Don't do that, because the pressure that you will be under to make money trading will make you make the wrong decision at the wrong time. You will panic when you shouldn't be panicking. You will get too greedy and vice versa. And it makes you do the wrong thing at the wrong time. So it's really important to take it slow, educate yourself, and really, again, just don't go in thinking it's a get-rich-quick scheme. It is not. In fact, it's the opposite. It will make you poorer in the near term until you find out how to read charts and how to control your emotions.
I worked in venture capital for a long time in China, and it's exactly the same with VC money, right? Like if you really need it, that's when it gets tricky, because you tend to screw up, you tend to make decisions that are not rational. If you don't really need the money, but it's a nice boost, hopefully you're cash flow positive, you're making some money, then it's a nice, addition to your balance sheet.
That's right. And I think that's the important thing, is that, you have to be in a good place financially before you get into it. Because I think people that get into it without that, they look at it as like that financial freedom thing, which eventually it can be, but it will test every angle of everything. Your financial angle, you'll be tested, you'll lose, so just be aware of that, folks. It is a tricky career. It's doable, but it takes a lot of work. Just like, and I always like to use this, is like, if you're going to be a surgeon, if you're going to be a brain surgeon, think about the amount of study and classes and education you go through to make that type of salary. You can make that as a trader, but in a weird way, you almost have to pay in the same amount to the market and go through the same amount of learning to get to that point.
A more specific audience question: how to avoid slippage in your stops? I am paranoid about gaps screwing my trades. So maybe you can give a bit of tips about, trade execution and how's a professional like you executing his trades.
So I always use limit orders. And so that's one of the things, is a lot of investors use market orders. And market orders, remember, when you put a market order out, there are algorithms that are millisecond algorithms that will change the bid and the ask, and you will get the worst possible fill within that range possible. And so by using a limit order, you're saying, I want this price or nothing at all. And you have to be okay with that as an investor. Sometimes you won't get filled. Okay, so no big deal. There's always another trade coming around the corner. but I would much rather always get the price that I want or not get it at all. And investors have to be okay with that. So slippage does happen. And again, it's something that we deal with, but there are ways to mitigate that risk.
Another audience question, please ask him what the difference is between trading professionally and trading a personal account, the pros and cons of trading a personal account and trading an institutional level.
So I think there's a couple angles here. So a personal account, it's under you. You're taxed. I mean, depending on the country, you're taxed in different ways. In the U.S., it's taxed as income. If it's short-term capital gains, it's taxed as if I'm just making it at a job, right? At an institutional level, you'll get more buying power, but you have to have proven yourself most likely. Like no institution's going to just hire someone off the street and say, hey, here's $20 million, go to it, right? You have to be able to prove yourself. Having said that, the liquidity and the amount of buying power you'll get with an institution will be much, much greater if you know what you're doing. But then there's also the risks of bigger losses, of potentially, I would say, also trading those bigger portfolios. You're not getting 100% of the profits, right? So the institution will take, anywhere between, I would guess, 50 to 80% of that, and you'll get bonused out based on whatever your agreement is. So my philosophy is always, if you have the means, always use your own money to trade, because then you make 100% of the gains. But again, learn how to trade first on a little money. And by the way, that's another great point. Is like, you might have $1 million. I don't know how many people do. That's probably not a lot. But just because you have $1 million, it doesn't mean you put $1 million in and learn how to trade on $1 million, because you will lose $1 million. Start out small. Start out at $10,000 or $20,000. Even if you have that million, prove to yourself you can consistently make money on that, and then up that amount by, let's say, 50K. And then if you prove again that you can make it on 50K, up it to 100. And if you prove to yourself that you can make it on 100, keep going. Because again, the more money you have at stake, the more emotional risk you come into. And emotion literally is what wrecks people. People buy at the highs, like on Bitcoin at 74,000, and they sell at the lows like at 15,000. And you have to be able to avoid that.
Another question about an investment strategy by the Danilko. What if you follow a top hedge fund and do exactly the same trades as they've done? Is there any chance to get a positive return on your portfolio?
So the tricky thing is for hedge funds is that you won't know their trades until they have to report them. And so by the time, and this is always drives me nuts, because we even see like Warren Buffett's, new investments coming to light and they're announced, but they're already like literally weeks or months after he's done it. He could even be unloading those when that news hits the open market. And so just be aware as an investor is that by the time you're getting the news about what a hedge fund is in, they've been in probably for weeks or months, and you don't necessarily want to chase those same things. All right. Now, if let's say they bought XYZ and it's down 15% and hopefully they're still in, then you might be getting it at a discount, but still do your due diligence, right? I'm a big proponent of self-responsibility in every which way, and in managing your finances and managing everything. And so just because someone else does something, just because I say something, for instance, I might say I like, Apple or whatever. Forget what I say. Do your research, decide for yourself, and then it's always a bonus. If you like it too and you say, oh, Gareth likes it, well, then that's nice, but you always do your own research.
I saw that there's this app or whatever called Autopilot that enables you to track politicians' trades. So you could, follow Pelosi's trades.
Yes, I've seen those too, and so this is the kicker, right? Is definitely they have inside information. Number one, they shouldn't be able to trade. There's no doubt about it. I mean, it's just even if they're not doing it maliciously or with shady information, it just looks like they are. And so as a politician, you just got to be smarter. Just don't trade. Like, put your money in a mutual fund or put it in follow the S&P, whatever you got to do. But just understand that it just comes across bad, regardless of whether you're doing it on purpose in a shady way or not. Having said that, I've seen many trades that these politicians have made that have been horrendous. The ones that work out, like NVIDIA, like I still remember, Pelosi went into NVIDIA and it was just, holy cow, what a trade. Those are the ones that get highlighted. And so you really need to see the whole picture. I wish we could get all of the trades published, look at the 5-year track record and see, okay, did she really do that amazing over the course of that period? Or is it more like a normal investor would have done if they just kind of did these kind of things? So it's tough to know, but again, it's one of those things where at some point, the government's a mess. I mean, I don't I don't know what else to say about it, but it's just there's so many things that need to be corrected with our government here. That's for sure.
Yeah. Last question. How do you navigate the ethical considerations in your trading practices? We have someone asking about, Islamic mutual funds that were with companies that don't deal in drugs, alcohol, and so on. Is that a consideration?
So to be honest, I'm a swing trader, so I'm a much shorter trader, shorter term trader, meaning I'm in and out in weeks or in a month or two. I don't put a lot of stock in that. What I do as a trader is I look at the chart, and you could show me a chart with no name on the company, no nothing. It might be a commodity, it might be a crypto, it might be a stock, and I'm going to look for what I look for in those charts, and I make money. And I look at it like this, is like, ultimately, things that are negatives will eventually get weeded out of society because there will be an uproar, there will be people that don't want to work for those companies, etc. But for me, my job is to make sure that I make money for my family. My family's my first priority, right? And making sure that my family has food on the table and a roof over their head. And so if I see a good chart, I'm going to trade it regardless of what it is. And again, that doesn't mean that I don't disagree with certain things. I do, but I still have a responsibility first and foremost to my family.
Gareth, I think this was not only very insightful, but also very educational for our audience. Where can people learn more? Where can they educate themselves more? Where can they connect with you?
Oh, wonderful. So you can find me on YouTube, on Twitter, both places free, and even Verified Investing. I just launched this new website for Verified Investing. The homepage alone has all the data and insights that I wish I had as a trader growing up, as an investor growing up, all the data. And we really try to be a company where there's no bias, there's no narratives. We present the data, the greed and fear indexes, the earnings calendar, the economic calendars, the different charts and what the technicals are saying. And that's for everyone to see and just make their own assumptions. And then inside of that, we have services and educational courses if you're interested in going a step further. But that's really where to find us. And I do hope everyone checks out the homepage because it is just so useful as an investor.
Gareth, thank you so much. We'll have you on again.
I would look forward to that. Thank you so much for having me.
Thank you. And don't forget to like and subscribe. Bye-bye.